Lesson 11. How to read stock charts like a pro. Chart reading is one of the more difficult skills to master. In this lesson, Bill O'Neill gives specific examples and discusses the finer points of chart reading as well as exceptions to a few of the rules he has covered. Some charts look good at the moment, but not all stocks go on to make big gains. How do you tell the difference between a sound base and a faulty one?
The real value of charts is in evaluating a stock's activity in relation to its recent past, its environment or setting. With all the factors that can affect the market, from the Fed and interest rates to international markets and politics, a stock chart, with its relatively simple price and volume lines, represents actual performance of a stock in the marketplace. The PeopleSoft chart on the opposite page is a good example of how little details can make the difference between faulty bases, prone to failure, and sound bases that may be extremely profitable. Points A, B, and C in 1993 appear to be the cup portion of a cup with handle. However, the handle area from point C to H is wedging upward along the low points at D, E, F, and G. Each point inches up a little higher along the low points. Most bases that do this will fail after they break out, which this one did at point H. Also note that weekly volume at the bottom of the chart was lower on the breakout week, point H, than the prior week. This is another bad signal. The volume should increase on the breakout week when compared to the week before. PeopleSoft built a second base from points H to L. This time the handle drifted down from points J to K, which is better, because it shakes out weak holders by undercutting the closing low prices of the prior few weeks. Handles, however, should not form in the lower half of the overall base, which this one did.
How do you measure to see if the handle is at the mid to upper part of the base versus the lower part?
Take the absolute high price 19 7/8, point H, and the absolute low in the base of $13, which is an overall decline of 6 7/8 points. Now take the peak in the handle of $17 and the low of the handle, $14. The midpoint in the handle is $15.50. Now, is $15.50 closer to the $19 7/8 point high, or is it closer to the $13 low? It's only 2.5 points off the low and is 4 3/8 points from the high. The midpoint of the handle is closer to the lower half, a weak sign indicating a faulty base that you would not want to buy when it tries to break out, point L. Note also the enormous volume selling week at point X, when PeopleSoft broke below its support price of $15, established 2 months earlier. It takes time to learn these intricacies. Even experienced chartists can get suckered into buying at points H and L.
Where does PeopleSoft set up properly?
The stock finally forms a third, more proper cup with handle from points L to P. The handle from points N to O is a lot closer to the midpoint of the base. This base is much tighter and better contained than the first one. 4 weeks down from point L, the stock breaks below its $16 support of 2 weeks earlier, but on rather small volume. This is better than the enormous volume selling week at point X when PeopleSoft broke below its support price of $15. Note also the big volume price run-up in week Y, as well as the huge volume at week Z. At first glance, you might misread volume at week Z as a negative sign. It's actually a sign of major support buying. Here's how to interpret this action. For the 2 prior weeks, the stock closed down in price 1.25 to 1.5 points each week. The volume then surges, but the stock only closes down 1/8. I call this heavy volume without further price progress on the downside. It's big volume institutional buying support that stops the stock from continuing its decline and causes it to close virtually unchanged in price for the week. Now you have 2 of the prior 4 weeks showing big volume support along the lows of the pattern. The correct buy point in this base is $18.50. Observe the extreme volume dry up the week before the breakout. No one is watching the dull activity. It's not so obvious. Then the breakout week brings a large volume increase at point P. This is the precise week where our institutional research firm, William O'Neill Co., recommended PeopleSoft to its institutional clients as a buy in August 1994. The earnings per share rating then was 99, and the relative price strength rating was 87. PeopleSoft's pre-tax profit margins were 23.5%, and its prior 5-year earnings growth rate was 163%. Additionally, management owned 50% of the stock. The PE ratio was 45 times earnings, and it later sold over 100 times earnings. And the average daily volume was 142,000 shares.
What other tips can help you find sound bases?
Most successful stocks, as they make their way up in price, build a number of bases, each one a different stage base. The first time a correct base is formed, first stage, generally it's a stock most investors are unaware of, so few buy it. Some people see the second base, but by the time the third and especially the fourth stage bases are formed on a stock's long way up, it's so obvious, everybody sees it. The market moves to disappoint the masses, and because most stocks that are obvious usually don't work, if you buy fourth stage bases, you will be wrong 80% of the time. When a fourth stage base fails, it will undercut the prior low in the base. Frequently, fourth stage base failures coincide with important turndowns in the general market. If the stock later rebounds and begins making new bases, the bases reset, and you begin counting bases all over again. Chart price and volume action can frequently help you recognize when a stock has reached its top and should be sold much sooner than negative changes in earnings signal a problem. For example, when the oil service stocks topped in October 1980, most of them showed earnings up 100% or more, and analyst estimates were terrific for the next several quarters. But the price and volume action showed heavy distribution, professional selling. This indicates the time to sell, no matter what the fundamentalists are saying. I scan a chart book looking for sound patterns in stocks that fit the CAN-SLIM formula discussed in my book, How to Make Money in Stocks. A sound base should usually have more weeks in which the price is up on greater than average volume than weeks down on greater than average volume. There should also be some tight weeks that show little price change. I like to see a huge weekly volume spike on weeks of price increase once or twice in the past 12 months of price and volume action. Most big stock leaders, after they initially break out of a sound base, will go up 20% in 8 weeks or less from their pivot point. I never sell a stock that does this in 4 weeks or less. 60% of the time, leaders will not pull back to the point of their pivot or buy price. However, sometimes you can make an additional buy the first time a stock pulls back in price to its 50-day moving average line. I recommend you study charts, and you'll start to recognize patterns. You'll discover things you never knew before about stocks and how they behave. Cut out and save patterns of really great performing stocks, so you'll learn what to look for next time. History always repeats itself in the market. Patterns that worked 5, 10, and 15 years ago work just as well today because human nature and investor psychology never really change. One place to start reviewing charts is with Daily Graphs Online, found at www.dailygraphs.com. Keep in mind that general market corrections are natural and normal adjustments, not something to panic or lose your confidence over. They help build another round of bases. Without corrections in the market, there would be a lot fewer correct cup with handle formations. It's the downturns that help create the left-hand side of the cup. It's really a matter of perspective. With strict selling rules in place and a solid way to interpret what the general market indices are doing, you can afford to sell some stock around a top and wait for a whole new round of future PeopleSoft patterns to form. In time, they always do. These new patterns are something you can't afford to miss, so never let yourself get discouraged and give up during market corrections.
Summary. 1. Most successful stocks, as they make their way up in price, build a number of bases, each one a different stage base. Third and especially fourth stage bases are prone to failure. 2. Chart price and volume action frequently can help you recognize when a stock has reached its top and should be sold. 3. Study chart patterns of past winning stocks. You'll be able to learn what to look for in the future. History always repeats itself in the market. 4. Look for handles that form in the upper half of the base. 5. A sound base should usually have more weeks where the price is up on greater than average volume than weeks down on greater than average volume. 6. Most big stock market leaders breaking out of a sound base will go up 20% in 8 weeks or less from the pivot point. I never sell a stock that does this in 4 weeks or less.